Why, of the four banks that reported today, Morgan, Citi, Bank of America, and Wells Fargo, why is Citi the only one that's higher, and it is the only one that reported a loss? The others all had profits. Explain.
Well, the Citi loss was driven primarily by some of those special items that you highlighted, the FDIC charge, and then they also had some kind of one-off charges on Russia and Argentina that they disclosed earlier in the day. Overall, I'd say the core fundamentals for all the banks that reported today for the fourth quarter were actually pretty close to what we were expecting, certainly. So I don't think there were any real fundamental surprises.
Were there any disappointments here that would explain why these four banks, with the exception of Citi, are all trading lower today? Not by a ton, but a little.
Yeah, I mean, I guess I'd say there was a range. I would say J.P. Morgan's guidance on net interest income for the year ahead was slightly better than previously expected. Mm-hmm. Wells Fargo's was slightly worse. And then if I look at Citi's guidance specifically, they had given very vague guidance about 24 previously. Previously, what they'd been telling people is that, the expense curve is going to bend late in 2024. But how much is it going to bend? From what baseline is it going to bend? And stuff like that was unanswered before. And, the guidance they gave for 24 today was kind of, our estimates are slightly above consensus. And the guidance they gave today was that, our revenue estimates were kind of at the low end of their range, mm-hmm. and our expense estimates are kind of at the high end of the range. So, they're giving pretty good guidance compared to consensus. And then there's also further guidance that in 2025, expenses should be down a bit further. So I think what the street is taking away from all that is that they're having confidence that during 24 and 25, you're going to see kind of stepwise progress to their intermediate term goals of 11 to 12% return on equity.
What's going to get
and just to put that 11 to 12% into context? That's roughly $10 a share.
What is going to get investors excited about these banks? Here you see a company like J.P. Morgan Chase, record profits, up 32% to nearly $50 billion for the year last year. And yet these stocks, which seem to be doing, these stocks don't seem to be moving, even though the companies are doing really relatively well.
Yeah, well, that's what creates the opportunity.
Right.
And it's interesting. I cover two different groups. I cover the alternative asset managers and the banks, and they're all engaged in wholesale finance. And, a lot of the regulatory pressures, they have been pushing assets out of the banking system and over towards the alternatives. And, we can debate all day whether that's right or wrong or good or bad. But what it has done is it's made the banks less risky. It's created a lot of opportunities for the alternative asset managers. And what's interesting is that last year, the average of the alternative asset managers, they were up by roughly 50%. And the banks were down 8 or 10% on average, in a market that was generally up. So, it's to, what your prior guest, Cole, said, you have to also be sensitive to valuation, that, mm-hmm. These stocks are an extraordinary value relative to the market multiples. And again, they've been de-risked. But I will tell you, I think there are a lot of institutional investors that just don't want to hear about banks because they just don't.